Hello everyone. In this video, we will discuss about what is an equity. We can say equity, or we can also say equity shares or share, a common share, stock. Sometimes it is also called as a scrip, right? So all means the same. Basically, these are securities held by owners of an organization. Equity shareholders, when I say it is, they are actually the owners of the company that issues the shares. For example, if a company issues 5,000 shares and an investor buys 1,000 shares, then the investor is considered to own 20% of the company. Further, the shareholders are entitled to a share in the company's profits based on the proportion whatever they hold. For example, in the previous case, that particular shareholder is holding 20% of the shares. Accordingly, whatever the amount what the company decides to be kept for dividend, that much of percentage of whatever his holding he may be entitled to receive as a profit, which is in the form of a dividend generally. Profits in the form of dividends. And these dividend rates are variable. Reason is the company may divert their profit to some extent to some other purposes, for example, for future profits, or they want to maintain same dividend rates for different times or different years. So they don't want fluctuations in their dividend, so they have a consistency. So the rates may be variable. It may not be exactly as per the proportion of the profit. Generally, over a period of time, the profit is expected to grow. Once the time increases, even the profit is also expected to increase. That is what is the general. So when the profit increases, even the dividends are expected to grow only. And dividend per share are likely to fluctuate because dividend rates are variable. So dividend per share also likely to fluctuate. Then we generally, for making a cash flow schedule for such equity dividend payments, we always assume about the growth in percentage. So based on the growth in percentage, we also consider what is the expected dividend for future. So the entries in the cash flow schedule are uncertain. It is not a clear-cut uncertain figures. So depending on the growth and depending on the performance of the company, whatever information available, based on that, we may prepare a cash flow schedule. So as we already spoke about, it may not exactly, the dividend may not exactly match your profit, or the proportion may not be the same as per the profit, because the companies hold back some profits for their new projects or expansion, or to maintain dividends in the future years. Again, the company may also buy back some of the shares from some investors, which may lead to greater future profits to the other shareholders from whom they have not bought the shares back. So the existing or the people who have not submitted their shares back or did not sell it back to the company will get a better profit in their future. So that is what is about equity. In our subsequent videos, we'll learn some more aspects in financial mathematics, right? Till then, take care. See you all.